Hello again. I'm sure you're very keen on getting to the next part of our discussion, and for this, we shall be inspecting in closer detail financial instruments. Let's start with a question that I am sure will pique your interest. How do you earn from financial instruments? It's only natural for us to wonder that, right? I mean, if I have extra resources, I would like to get earnings from these resources. So, how do investors earn from financial instruments? Or to use the appropriate term in finance, what is the return on these financial instruments? Now, we have to remember that you can either trade your financial instruments or you may decide to keep them. In other words, you may buy or sell or hold said instruments. Let us first talk about investment classes. An investment class is simply a group of investments that exhibit similar characteristics. Fun fact, an investment class is sometimes called an asset class. There are a lot of investment classes, but the following are the two most common: equity securities and debt securities. Now, what are equity securities? Well, I'm pretty sure you have heard of this. An equity security, or a share of stock, represents part ownership in an entity. It is therefore necessary to appreciate that if a surplus unit invests in a stock, the surplus unit becomes a part owner of the deficit unit. It's like saying if you buy shares of stock of a company, you become part owner of that company. Amazing, huh? Now, think about this. What do you expect to receive if you are an owner? Share in profits, of course. In accounting and finance, we call the share in profits of a corporation as dividends. For as long as a surplus units, let's call it the investor, decides to hold on to its investment in equity shares, it has the right to receive dividends. But what if the investor decides to trade its shares? Then it can either get a profit or loss from the said trading depending on the changes in the market price. Take for example Mr. I, an investor, who bought 100 shares of stock for Company D for 120 per share. If Mr. I is able to trade his shares at the current market price of 150 per share, then he enjoys a 30 peso profit on each share. Consequently, if Mr. I was only able to trade his shares at the current market price of 100 per share, then he suffers a loss of 20 pesos per share. To recap, if an investor decides to hold his investments in equity securities, his return is represented by dividends. However, if an investor wishes to trade his investment, he can either get a profit or loss depending on how much is the market price when he traded it. Next, let's talk about debt securities, particularly bonds. A bond is a fixed income instrument that represents a loan made by an investor to a borrower. It is therefore a liability of the issuing company that promises to make payments periodically for a specified period of time. The investor is a creditor of the deficit unit. Take a second to think about this. The investor is not a part owner, but a creditor. What difference does this make? Well, lots. For one, because the investor is just a creditor, he is not entitled to the profits or earnings of the company. Ergo, he has no rights to the dividends. But because he is a creditor, thus an external source of funds, the company is obligated to pay him back. In the distribution of the deficit unit's assets in case of liquidation, the creditor will be given priority over the others. Also, because a bond is a liability of the issuing company, it has a maturity date, or the date when it becomes due and payable, and bears interest. This means that upon maturity, the borrower must repay the creditor the maturity value, that is principal and interest. As we very well know, interest is payment on the use of borrowed funds. Therefore, the return on an investment in bonds or debt securities is interest. If the investor decides to hold his bond investment until maturity, he is therefore entitled to receive interest across the term of the bond. But a bond can also be traded. If the investor is able to trade the bonds for more than its face value, then it's said to be traded at a premium. If it is traded at less than face value, it is said to be traded at a discount. Interesting, huh? Bond premium and discount is super interesting that it is covered in one of your modules in intermediate accounting. Quick question before we leave this topic. If you were a deficit unit, which would you prefer to issue? equity securities, or debt securities. Nonetheless, there are a lot more investment classes to discover, such as currency, real estate, and commodities. And I promise you will meet these investment classes in one or more of our future discussions. Until then, see you in the next video.